Welcome to the Inside Housing Podcast, where we break down the housing process, real estate, and investing. Here we go. Krystal, welcome to Inside Housing Podcast. How are you?
I'm well. How are you?
Really excited you could be here. And by the way, I should say I feel honored because it's your birthday. So happy birthday.
Thank you.
I really appreciate you coming out. And I'm very excited to talk to you and kind of learn about what you do.
Yeah.
And why don't you introduce yourself?
Of course, yeah. So my name is Krystal LaRose. I am a mortgage lender. So I'm a mortgage originator for a mortgage lender. I've been in banking since about 2008 with a local bank here in Vermont, switched around a few times. I just recently switched to a national lender in December of last year.
Okay, so a couple things, because I've learned this with lenders. What's your license number?
My NMLS number is 1401742.
Okay, we knocked that out.
Yes.
What's the difference between local lender and national lender?
Yeah. I think that's my favorite question. And when I was moving actually from one bank to a lender, I had a customer ask me that. And I thought about it and I had to educate myself a little bit because I wasn't quite sure what I was getting myself into, other than I just knew that I was still going to do mortgage lending. And as I did some research myself, familiarized myself, there's actually quite a few differences. On the local level, the bank has its own policies, its own procedures, some overlays to regular guidelines that have to be followed, but they kind of have a little box. They originate and lend within their little box. The national lenders are a little bit different. We have multiple lenders, brokers that we can brokerage a loan to. We have multiple different products, different options, less overlays. So if it's Fannie Mae approved, Freddie Mac approved, we essentially sell the loan. We do mortgages all day long. So there's less overlays and a lot more flexibility. On a local level, again, they have that little box, so it's a little bit different, where thinking outside that box, taking a risk can be a little bit more risky to them because they don't do just mortgages. They're depository as well.
So what made you make the switch?
The very short, simple answer to that
It doesn't have to be short. It can be the long answer.
But the very short, simple answer to that is I kind of was sick of saying no. So I spent 5 years working with a local lender as a mortgage loan originator. And there's a lot of overlays, less risk that the local lenders are willing to take because it's a risk. And banks, it's hard for a bank to take a risk for many reasons.
Now, when you say a bank takes the risk, are you talking about when the bank holds the loan in-house?
So no, that's a little bit different. So if a loan is being held in-house as a portfolio loan, they're a little bit likely to maybe take a risk on that in a few loan instances. Vermont's actually a perfect example of that because we do have deer camps, we do have lake houses, we do have 3-season homes. So those are likely not saleable on the secondary market. So those are going to need to be processed as a portfolio loan. Those are retained in-house. They are not sold. So when I say taking a risk, I mean more, we have an automated underwriting system. If you put a loan through the automated system and it comes back that it's approved and eligible, if it's approved and eligible, it is saleable. There's no less risk factor to the customer's overall picture. So that loan itself, another institution will buy because it's not as risky.
Let me interrupt because I actually have to explain this quite a bit from the real estate side to people that I'm working, especially first-time home buyers. Your second or third, most people understand what happens is with mortgages, but how would you explain that your mortgage gets sold on the secondary market? Because not a lot of people understand that that actually affects loan types, it affects programs you can use, it affects properties. So what is that for somebody who doesn't know?
Yeah. The simple answer for that is your loan is processed with an institution, so let's use just the local bank, for example. If the local bank is not selling the loan, they're keeping it. You are applying with your local bank. They are doing the processing. They are keeping the loan. You're going to make payments to them. Maybe they sell it and they maintain servicing, so you would still contact them, but the loan is technically owned by somebody else. And the very easy way for somebody to understand something like that has no idea is a bank has to make money. They can't give money if they're not making money. So if they have billions of dollars in loans, eventually their big loan warehouse is going to run out of money and they're not going to be able to produce loans anymore. So they sell them to free up that money, and then somebody else can borrow that money. National lenders, like what I do now, is we take the application, we process the loan, we have our own underwriters. You work with me the entire time through. We do everything from front to back. I'll hold your hand all the way to the closing table.
The whole time.
Once the loan closes, it is then sold off to another institution, which is a mortgage institution. So that is sold off to that institution. That is now who services your loan. You make your payment to whoever,
Mortgage,
Freedom Mortgage, New Res Mortgage, whatever the company might be, wherever it's sold to, you now make your payment with them. That's where your loan is housed. On the local lending side, when I had said they may maintain servicing, but the loan may be sold, it's because they have a servicing retention agreement where you still make your payments to X Bank. You can still call X Bank, but X Bank bought that loan from the lender. So that lender now has more money to give somebody else a loan.
Gotcha. And now you're with Envoy.
I am with Envoy Mortgage,
And
yep.
they're a correspondent lender.
Yep.
And so that's new to me. It may not be new to everyone, but how would you explain then how that works?
So that's exactly kind of like what I was just saying. So you work with me the whole time. A correspondent lender is a lender. They're a mortgage lender. They're a mortgage institution. And mortgages all day. That's what we do all day long. Multiple different options, programs, products. The application is started with me. It's processed with me. We have direct contact to our underwriters. So it is very hands-on, timely, efficient because we have direct contact with everybody. We hold it from front to back, get everything done in a very timely manner. And then once it gets to closing, it's sold. That's the correspondent. It's usually the loan is sold. In some cases, they may maintain it. But again, selling money means more money available. So that's a very key ingredient to that. But it's not so much, I guess, I wouldn't call it so much different than one versus the other. I think it's just who you work with through the process and where the loan ends up in the end.
Okay. All right. That makes sense. Kind of going back, go forward. So you've been doing this for about 15 years,
So I've been a mortgage lender, mortgage officer for 5 years. I've been in the banking industry since 2008, where I did absolutely everything. I actually started in
So you started
loan
during the crash.
servicing. Yeah.
Okay.
But I didn't know that though, because I was actually in loan servicing. So I was literally, my first job in the banking industry was in loan servicing for Chittenden Bank. And I worked downtown Burlington from 9 to 6 in a call center, just taking customer calls all day long. And that's how I learned about what these loans were, but they were already in the system. They were already processed. So these were servicing questions of, my payment is due here, my escrow account changed, something here changed. I have a question about my statement. So those were the calls that I was taking. But then I actually got into, with Merchants Bank, I got into more of the processing and closing side of things. I knew the servicing side. I knew how the processing was working, how the underwriters were going, what they were looking for, what the conditions were. I knew everything on the back end. I never knew what happened on the front end. How did the application come in? Where did these people come from? I have all of this information, and where did these people come from? So I never knew that part, and it wasn't until 2021. Yeah. And when I said, I want to know who starts this process. How does this end up through to me? Where's the beginning? Because I knew everything in the back. I just didn't know the beginning. So that's when I just started getting into wanting to explore more, applied for a mortgage origination job and got it.
And that kind of led you here.
And that led me right here.
All right. So if you were talking to first-time home buyer and they were just trying to figure out this landscape and What's the menu of options for lending that somebody has potentially in front of them? Because there's just, and the reason I ask that is when the agent goes out, and we're shopping for different houses, we're having to take into account the kind of lending that somebody's using, right?
Absolutely.
Like obviously you could say cash is king
Yeah.
most of the time, but the lending you use affects the properties, what you could do with them. Some are disqualified for certain lending type. As a veteran, I've used VA loans numerous times. So what's the menu that somebody has available to them?
That is an excellent question. And the very long answer to that is going to be if you go to a restaurant and you try to memorize the entire menu to know what you want, the next time you go back there, you're probably not going to remember everything that's on the menu, or maybe something has changed. The lending guidelines are always changing. Products, pricing, it's always changing. So I think the menu itself is going to depend on a few factors. What does your credit look like? What does your income look like? VA, USDA loan, which is a rural development loan. Depending on the person, I think is going to depend on what the menu looks like. There are multiple different products that maybe one qualifies for and one does not qualify for. There are first-time homebuyer programs. I like to look at those programs as not necessarily just a product, because it's not its own product. It's a program that is offered with another product. Vermont has HFA,
Does that stand for?
Vermont Housing Finance Authority, maybe. I don't do VHFA loans anymore, unfortunately, because they do have a requirement that unfortunately Envoy doesn't meet in Vermont yet, just haven't been here established enough. So in the future, I'm hoping to be able to do that. But right now, unfortunately, I cannot do VHFA loans in the position that I'm in. But we do have a first-time homebuyer program that actually, if you ask me, is better.
What is that?
It's a first-time homebuyer option that goes hand in hand with an FHA loan.
Okay.
The FHA loans are somewhat credit sensitive. You have to have a certain credit score, 620, 640, depending on each circumstance, how many borrowers. A lot of factors play into different things with that. But we have a down payment assistance program that is not specific to being a first-time home buyer, and it is not income sensitive. Somebody who does not qualify for a VHFA $15,000 grant because they make too much money may qualify for a 3.5% grant. It doesn't matter how much money they make. That's probably my favorite part. So I do tell people, don't get wrapped up in looking at what can I qualify for as a first-time buyer, because there are certain programs that are only allowed for a first-time buyer. Those are mostly income restricted, but there are programs out there that you can be a first-time home buyer or not.
So when you are working with someone and you're shopping the menu, you're really trying, it sounds like you're trying to match. You're trying to match
Absolutely.
their circumstance to the best loan type, and they may have a couple loan types that
Absolutely.
they're eligible for, and that then informs them of what they can do.
Of course.
Currently in Vermont, it may be a shock to some, but there is a bit of housing crisis in terms of we have a lot of people leaving the state, and I coined this term the other day. I was talking about we have the expectations from sellers. So your sellers' expectations of what they'll get for their property, but then you have buyer's math. And buyer's math is really comes down to like, what's your mortgage payment? How does that figure in? What are you seeing on the lending side that's changed over the last 5 years, and the kind of people that you've been seeing, and what are the things that they're bringing to you? Lending is where it starts, and I didn't even get into pre-qualification, pre-approval. I'll ask that later. What are you seeing right now?
So I think looking at what has changed, speaking from personal experience, we bought our house in 2019. In 2019, there were seller concessions. There wasn't so much of a fighting market that I experienced personally. There was COVID. There became a bidding war, no seller concessions. House prices skyrocketed from what they were. So that's the obvious change. The not so obvious change that I continue to see probably over maybe the last 6 to 8 months is seller concessions coming back. And no more appraisal gaps, no more waivers. Buyers, I think, are actually, instead of just jumping in head first without asking questions or waiving certain rights, I think they're being a little bit more cautious now. But I also think that is to their advantage because some of, going back to the down payment assistance programs and some of the other options that are available, a seller concession could be exactly what that buyer needs. Because if they have very little cash down, which I'm seeing a lot of, I get a lot of calls of, I don't have a lot of money, I have a decent credit score, I don't think I can buy a house.
You brought up COVID, and every time I think of it, I'm like, was that 5, 6 years ago? Because it seems like a whole lifetime.
Yeah.
But I remember that changed
It
the
was,
market.
yeah.
Changed.
Change.
The appreciation has not really gone down. So that almost seems like a new normal in terms of this is where we are with pricing. I am seeing more negotiations than ever before, even when there's multiple offers. So with that, the math though still is difficult for buyers. And it's, again, you always have the cash buyers, which is a whole segment. It's really not nothing. There's people that are coming in and they can afford to just, yep, I'll take it. Maybe they sold something that they had a lot of equity in, and so they can do that. But for the ones who are trying to finance, it seems like liquidity is harder and harder to come by. So does that where the cleverness in lending kind of comes in?
Absolutely. You nailed that. That's exactly what it is. Cleverness. I like that word. I like to think
No.
I'm
Did I
clever.
get a gold star?
You do. Gold star for that. The reason why I love that is because clever is a perfect word for it. If the seller is willing to, and I giggle when I say this, back in the day, you used to be able to write a letter to the sellers saying,
Love letters?
yeah, I love this house, my family and I, single mom of 3. You used to be able to persuade the seller to
So different realtors have different opinions on them. Sometimes it has no effect, and I've actually seen it off-put certain sellers. And there's other times that does sway somebody selling, as like it or not, that people take into account situations. And I just came from a training where we were talking about the emotions behind buying. And there's a lot of them, sell side and on the buy side. So yes, those letters can make a difference.
So they used to be a big thing. I heard about them all of the time. But I think when they were a big thing was, like you said, emotions from the seller and the buyer. Take into consideration somebody who's selling their first home where they've lived there for the past 15 years, 16 years. They started their family there. They built their roots there. Their kids have graduated. They're moving out of state. They're downsizing, whatever it might be. They're selling their what was hopes and dreams at one point that have now evolved into so much more. And the emotion behind that love letter, the person who writes, I'm pregnant, I'm moving into this, I want to move into your beautiful home because I want to raise my family. The seller can feel that emotion, and that could sometimes be where the persuasion comes in. But where I was going with that was my understanding is you can't really do that much anymore. Some realtors don't love it, maybe some do.
My understanding is that it's subjective and it depends a lot on who you're working. I'll have to go fact check.
On the other side of things, though, I think a lot of times how are you getting financing kind of plays the same effect as that letter to me, because if the seller needs to know if they're getting down payment assistance, if they're getting an FHA loan, if they're paying cash, whatever type of loan, is it a VA loan, is it an FHA loan, those loans can be trickier to get. There are certain other guidelines. There's things that need to follow. So the seller may say, well, I'm not going to give to them because they're doing an FHA loan. I kind of look at that as the same thing as the letter.
It is a factor,
Yeah.
especially if you're in a multiple offer situation. The kind of financing from a seller's perspective does influence really, like, are we going to get to close?
Absolutely,
and
that makes sense.
That's where you are having to look at those and sort of see which is the strongest. And it's based or coupled with other options, right? So you have to look into how long do they need to close? Are there going to be other contingencies? So those are certain things.
The reason why I bring that up is our down payment assistance program that is partnered, goes hand in hand with an FHA loan, could be what the family that's looking to buy that home needs. The reason I say that is because if we go back to the seller concession, if the seller concession comes back around, they're getting an FHA loan that has a 3.5% down payment requirement. They're getting a down payment assistance for 3.5%. That covers the down payment they need. Now all they have is closing cost. If you have a $10,000 seller concession,
You can bridge that gap.
you can bridge that gap. And now that helped somebody who didn't think they were qualified get the house of their dreams.
Yep. And I've actually done that a few times. Not all buyers know that you can do that. And so a lot of times I try to educate them. I'm like, it doesn't work in every scenario, right? You usually have to find a property that there may not be multiple offers and maybe sitting there and somebody's like, yes, you know what, I'd like to sell it. The one thing I always try to advise is it has to appraise. And that is one of the things I want to do is get an appraiser on here one day because appraisals just vary. But if it does appraise, then that's a tool that they can use. So you're seeing more of that.
I am seeing more of that. And also, fun fact, I used to work for an appraiser. That was probably a job I'll never go back to again. From the banking perspective, a lot of times I would just scratch my head. I just know what the agents and what the banks want to see on those reports. So working for an appraiser was a challenge because I knew what they were writing could make or break a deal. So that was, my brain was like, no, don't put that in the report. But of course they have to. So chatting with an appraiser would probably be very interesting. And I would love to hear that podcast.
A question that I had for you is, particularly in Vermont, we have a lot of people who are self-employed, seasonal workers. They don't hold the normal W-2s in the conventional sense. So how are you potentially advising them in terms of what can you do and can't you do? Because then there's the other side of that is especially people who are deriving their income from rental assets or things like that. Like you get into the lending world and they're like, yeah, I have all this money and I want to try to do it. But they're like, yeah, I don't know if we can back it. So how is that process evaluated?
So this part is new to me, which I'm super excited to learn more about, but there are options for statements. If you can show that you have money using bank statements without having to use W-2s. Self-employed income gets a little bit dicey in many situations where they show that they're making no money on their tax returns, but yet they do have a lot of money depending on what they're writing off. Depreciation can be added back in. So there are some strategies when it comes to self-employed income specifically. It is an average over 2 years. So you do have to have 2 years of business tax returns. And the income that you're telling the government that you make is factored over 2 years.
So what if somebody has a year of W-2s and a year of self-employed income? Can you combine them?
You cannot.
You cannot.
If you are self-employed, Fannie Mae guidelines, you have to have 2 years of business tax returns. We can use assets depending on, was there an asset depletion option? You have to look at the whole picture to see what else they have. But if we are strictly talking self-employed income, you have to have 2 years of business tax returns.
Is lending getting harder or is it always just had this much nuance?
I think it's just a matter of educating people on what the rules are and preparing people as they're making transitions. So I don't think it's necessarily getting harder. I mean, the rules are always changing. Yes, Fannie and Freddie change rules all of the time. They sometimes make it easier, so they sometimes make it harder. So things are always changing, but I wouldn't necessarily say that it's getting harder. I think that as lenders, we have to do a better job at guiding and educating people what they should expect based on their situation, which leads me to actually one of my favorite things that I always tell folks, partners that I'm working with, is if you send me somebody who's not ready right now, the answer is not no, it's not right now. Let me help you. Call me in 6 months, call me in 12 months. We'll see where you're at. I don't feel like the answer is never no. So I don't think it's getting harder. I think we just have to really educate people on what is the rules, the guidelines, and the expectations to get there from here.
So with that, when is the right time for somebody who's interested in potentially purchasing a home to have these conversations?
Yesterday.
Yesterday.
When you thought about it. If you're thinking about it, make a phone call. Don't think about it. Make the phone call. Because if you think that you're further away than you are, Your dreams may be closer than you think. With a couple of months of guidance, a couple of extra tools, you may be closer than you think, or unfortunately, you may be a lot further away than you think. Most of those situations, though, are credit related. I see that a lot. I see many times when we pull credit and we look, and maybe there's something going on from previous time, and somebody says, oh, well, that was part of my divorce, or was a repossession, it's not on there anymore. That doesn't count. It's not on there anymore. I don't have that car anymore. You don't, but you still have that ding to your credit. So let's work on getting you some good, solid credit reporting that can help make up the bad. That's probably the number one example that I can give you when it comes to I'm not ready yet, when people think they are. Those are the situations where I have to say, you might be ready now. Your job is ready. Your income right now is ready. Your credit is not ready.
Credit is not ready. But it's tricky because I sometimes wonder how they came up with the calculations for credit.
You'll never know.
To me, it's like dark magic.
Yeah.
You're like, okay, I'm going to pay off all these credit cards and do all these things. And then it's like, boop, barely changes.
Yep.
And then sometimes you open an account and you're like, oh, it goes up. And it's just it's such a janky system, in my opinion.
Yeah.
But it's real and we have to kind of abide by it. So,
unfortunately,
what are some general recommendations you give to people when it comes to credit and things they can do to strengthen it?
that's where we walk a very fine line. We have to be very careful with what we say to people just because you don't want to cross that financial advisor line. But I do want to offer some guidance from a mortgage perspective of what does it need to look like to qualify for a mortgage. That advice we can certainly give to people. But in most cases, the advice that I have to give are because there's derogatory marks, there's a vehicle that was repossessed, there's credit cards that they stopped paying on, there's things that happened in the past that basically haven't had the chance to season out yet. Time is definitely an answer to something that's happened recently. You need more time for that to kind of dissolve. On the other side of that would be if you have a low credit score and not enough trade line items on that score, my advice would be to help build that score, because that 3-digit number is going to control your life in many situations. So build that score up by, some people will tell you, don't open a credit card, don't buy a car, don't do this and that when you're trying to buy a house. Yes, but no, it's kind of a double-edged sword. If you don't build your score up, your credit doesn't need, it's not where it needs to be, but you don't want to do it too much, because what if your debt to income is... So it's definitely a fine balancing act that we have to juggle with, but even one credit card can help change your credit score. And it doesn't mean go max the card out. Don't go get a card and buy everything and max it out. There's kind of that magic 33% number. Use it, pay it, use it, pay it. By doing that, within a few months, you'll see your score increase.
It's hard for people, and I see that in Vermont a lot. And I think I saw a national stat that average credit card debt in the United States is just continually going up. And to me, it's indicative of we're all fighting inflation. You go to the grocery store, you do anything. The house that you saw like a couple of years ago is worth or priced at 50, 60, 100,000 more than it used to be. So I'm always sympathetic to people trying to figure that out and navigate it. And I think that's where like lending comes in. What I wanted to ask is, what's the difference between getting pre-approved and your pre-qualification?
That's my favorite question. A pre-qualification is kind of step one. If you have
step one was contact someone and get information.
Okay, step two. You probably have to call me, then we'll get like step 1.5 to step 2. The pre-qualification period is more you're submitting some information to a lender, and a lender says, based on the information that you've provided me, you appear that you would be qualified. So sure, we'll give you $300,000. You appear to be pre-qualified for that. If you are pre-approved, you've already been through the motions. You've already submitted all your financials. You, in some cases, could have a fully underwritten pre-approval, which really helps your strong offer.
So let's break it down. So pre-qualification is a peer to be.
We appear based on the information that you have provided. If you are providing true and accurate information, it appears that you would qualify for a $300,000 house. Sure.
And then pre-approval is you've already gone through.
You've gone through the motions. You've provided the documents supporting what you said. You've provided your pay stubs. You provided your tax returns, your W-2s, all the information, all of the financial information that the lender needs to prove what you said is true. That appear turns into approved.
And then the fully underwritten portion.
Yeah, that's actually my favorite. And I try to leverage that as much as I can because Envoy has a very unique, which is probably my favorite that I've come into since I've been doing the lending. We have the ability to fully underwrite and approve a loan, collecting all supporting data. It's been conditioned. The only thing we need is a contract. So the way that we can do it is when it has been fully underwritten and approved, it's as good as a cash offer because there's no other contingencies on the financial side. So they are making what is technically considered an offer with no financial contingencies because they've already been approved. No finance contingency.
So that would really just strengthen that offer.
Absolutely. The only thing we need is the contract and your addendums and whatever, if it's a condo, whatever those might be.
A question, that is separate from the requirements for the loan type in the house.
Separate from the requirements.
So if somebody's fully underwritten, they could be using a variety of different lending types, or am I mistaking that?
I see what you're saying. So I think if they, depending on their situation, were they fully approved on just conventional financing,
Exactly.
FHA, I think it's probably going to depend on the circumstances. FHA, as you know, you have to have specific requirements. You can't have peeling paint. You can't have this and that and another thing on the home. So they're a little bit more strict with the rules. So I think that's a conversation that we would have with a buyer trying to determine what they're looking for. So that fully underwritten pre-approval would be a financial contingency. So there's no finance contingency to your contract, but that doesn't mean that there might not be other conditions based on the type of home that they're going to be looking at.
So moving off topic a little bit, what do you enjoy about what you do? Because you seem very excited, very pumped up to be talking about lending types and how to help people with, as you say, the clever ways that you can use lending to get what you want and to get into the first one. So why do you like doing that?
Vermont's a very small state, born and raised. I've been here forever. We have this very small, lovely community in every one of our towns and areas in our state. And I like to think people are great. I think for me, when I look for something in my life, when I set a goal, when I reach a goal, any achievements or anything, it's a great feeling. And I love to be part of helping somebody reach that goal. And I know that it's probably the biggest financial decision of your life to buy a house. You could be starting your family. You could be already have your family is too big. You need a bigger house. I just think that people's hopes and dreams are so interesting, and I truly love and enjoy being part of somebody's success. So I think that's probably my answer is I love to help people.
So I don't have anything to say. I'm like, that's a really good answer. I just feel like we need more people who are like positive like that about, especially housing in Vermont, because I've had tough conversations about how the trajectory is going the wrong way. I'm still here, and I know a lot of people want to be here. And so I guess if enough people like you are fighting the fight for them, then that's a good thing.
You have to advocate for somebody, and some people, in a lot of cases, you've probably experienced yourself, first-time buyers don't know how to advocate for themselves because they don't know the questions to ask. It's not that they can't advocate for themselves or they don't know how to speak up. They don't know how to ask that question. So if you are working with a lender, a local Vermont face who's been here forever, I know Vermont. I know the properties. I know our communities. I know the people. And it's a passion to work with somebody and to advocate for somebody to get them into something that they didn't even know that they were going to be able to get.
I like it a lot. Last couple questions. I saw in your background that you were a dance instructor. So are you currently a dance instructor? What kind of dance? This is important information. Somebody's going to have you help them, their loan type. So.
I think it is very important on the aspect of it's all community based. So I am a local line dance instructor. I've been line dancing since I was probably 5-ish.
Like country music, line dancing?
It used to be all country music, but now it is so many different genres of music. It's all over the board. You cannot slap a genre of music on line dancing anymore, unfortunately. I am a very, very old country 90s music girl, though it is where my heart and soul is. So that's probably my favorite, which is what I grew up doing. But backing up to how I kind of feel like the line dancing plays into who I am, into the mortgage world, is I do a lot of events in our community. I partner with local businesses to bring in business, maybe on a slow night on a Monday or Tuesday night if something's not going on. So I partner with them to host public classes at their venues to help bring in business. I also did a local fundraiser that I will take 2 seconds to tell you about. I had my son 19 years ago, 6 weeks early. He was just over 4 pounds. And he stayed at the Vermont Children's Hospital. So again, going back to local support right here in our state, if we didn't have the Vermont Children's Hospital and the equipment, the community, everything that we have here, my son, 1, may not have survived, or 2, I may have been shipped out of state somewhere else. So every year since 2016, when I started teaching line dancing, I hold a fundraiser that goes hand in hand with WOKO's Big Change Roundup.
Wow.
This year was our biggest year yet. We raised over $28,000 that we donated to the Vermont Children's Hospital. So I am a big advocate of Vermont local community helping one another in every way possible.
I love that. It explains very much why you're good at what you do.
Thanks.
Krystal, I think that was everything I had. Did you have any last things? And I'll put your contact information so people can find you.
I don't really have any last things, but one thing that we didn't really touch on that I want to just throw out there is I don't want people to fear rates.
Ooh. Okay. All right. So we're about to add another 45 minutes.
It's okay. We don't have to go in deep details. I just don't want people to fear rates because they are all over the board. And I understand that a rate is a huge factor because it is part of your payment. A higher rate means a higher payment. It's not a forever commitment. You can refinance buy downs. There's a 3-2-1 buy down that goes back into the seller concession piece. The seller can help buy down. You can ease into rates. There's so many different options. And before you fear rates, again, I highly encourage you to just pick up the phone and call and have that conversation to see what options there are. And I wrote down actually a quote that I was talking to a realtor the other day with, if I can remember it, it was, if you have a seller concession.
I was going to say, is it marry the house, date the rate?
No, but that's a good one. I want to tell you what it was, and I don't remember it off the top of my head, but I found it. So, when it comes to rates, keep in mind, would you rather have a 6.5% rate with a $10,000 seller concession today? Or are you going to wait for 5.75 with 3 competing offers, no concession, and miss the house?
It's very true. Yeah. So one thing I see about rates, which is, that's difficult. And that kind of goes to my thought process earlier where the buyer math is a challenge because you buy a $400,000 home, that mortgage payment is different than it would have been back in the days when people are still
Absolutely.
living at 2.5% and stuff like that. That said, I always tell people, I said, tell me, aside from the small ups and downs we have, for the most part, how are these things going to be worth less over time? And I said, if you need to get into a home, it's either the right time for you or wrong. So that goes with what you're saying, and I like it. And the saying that I've heard quite a bit is,
I love that.
It's called marry the house, date the rate. 'Cause
It's
you
true. You can change it. You can refinance. There are options. So don't let rates scare you from building your hopes and dreams.
I like it. And they should listen. Well, Krystal, once again, happy birthday.
Thank you.
So glad you came in today.
Thank you so much.
And I really appreciate it.
Of course. Thank you. I appreciate you. Thank you for taking the time to do this.
Absolutely.